Welcome to KP Data Investing channel, focusing on finding the best investment opportunities on stocks whose prices have not yet accurately reflected on their true intrinsic value. Today, we are going to continue with our previous videos focusing on finding the diamond in the small cap stocks. Last time, we shared the complete thesis in our most recent purchase in Foot Locker and the decision of averaging down after reporting their earnings. Full explanation in Foot Locker can be found in the description. And here today, the stock that we are going to share is actually one of our highest conviction plays in the portfolio. This is a value growth stock. We believe most people might not have heard of it before, but after our due diligence, we think that this stock has massive upside potential. We bought the stock twice. The first time back in September last year, and the second time last week after they announced their financial report for fiscal 2021. Before getting started, remember to press subscribe and like button if you think our research work and due diligence is thorough and meticulous. Without further ado, let's dive right in. The company is called Medifast, with the ticker symbol MED. Most of the people might not have heard of the company until today's video. This company was ranked by Forbes to be on the list of America's best mid-sized companies. Forbes screened more than 1,000 companies with a market value between $2 billion and $10 billion to find the best performers. The list of top 100 ranking is based on earnings growth, sales growth, return on equity, and total stock return for the past 12 months and over the last 5 months. Among 100 top companies, Medifast was ranked on the 23rd, which demonstrates the competitiveness and quality of the company. Out of 1,000 companies, this company was ranked on 23rd, quite an excellent acknowledgement by Forbes. After speaking of the list, it is important for us to get a full picture of the company background and its business model. The best to find is to read their recent 10K financial report that was released last week. Let's get into it now. Medifast develops and markets products for consumers who want to lose weight by adopting a holistic approach to overall health and wellness. They have operating business in the United States, Hong Kong, and Singapore. The majority of the company revenue comes from the brand, Optavia. Other than diet and weight loss only companies, or to multi-level marketing companies, their model is different. They employed a direct-to-consumer business model to deliver growth for the company. From the last quarterly report ended in September, they said 91.9% of their revenue comes from subscription-based meal plan orders. We will talk about their options on meal plans in just a minute. In their products and model, they centered on developing new healthy habits through small and fundamental changes. The success of their subscription model is built around 4 key components, including independent Optavia coaches to provide individualized support and guidance, Optavia community that connect and support people in real time, transformational system that offers steps to a sustainably healthy lifestyle, and delivering clinically proven products and plans backed by scientists and physicians. Among all the components, we think one of the most powerful drivers to support the company's success and helping their clients to success is their community network of 59,800 coaches across the world. 90% of them were actually clients in the first place and now trained and certified to be coaches to help other people who have failed on diets and want to become healthy by developing the habit of healthy eating. The company also have now turning their focus on global expansion to fuel their long-term growth strategy by entering into Hong Kong and Singapore. Now, let's get into their subscription-based meal plans. Under Optavia, they offer 3 weights plans for the consumer. The Optimal Weight 5 and 1 plan encourages their clients to eat 6 small meals a day, with 5 meals that are actually Optavia nutritional products, which has a choice from more than 50 products, including shakes, soups, bars, hot beverages, biscuits, pretzels, pudding, and brownies. These nutritional products have been engineered to provide enough nutrition, such as more protein, less carbohydrate, and limited fat to the clients. The optimal weight 4 and 2 in 1 plan is for clients who wants to continue eating all food groups or want a flexible meal plan by having 4 Optavia products, 2 self-prepared green meals, and 1 healthy snack themselves. The optimal health 3 and 3 plan focuses on small meals, eaten every 2 or 3 hours consuming 3 Optavia products and 3 balanced meals they prepared themselves. Of course, many of you, including we, might ask the same question in the first place. Are these plans workable and effective? There is actually nothing in here if those meal plans are not delivering noticeable results. So, let's look at 2 articles that were published on well-known academic journals with quite high impact factors. Those who don't know what impact factor means, it is basically the higher the better in simple terms. On the left, article published on the International Journal of Obesity, the optimal weight 5 and 1 plan, which was the first plan we just talked about, was compared with a reduced energy and food-based diet program. The researchers randomly assigned the participants in either of these 2 groups. The results were promising. After participants engaged for 26 weeks, the 5 and 1 plan resulted in significantly greater reduction in body weight, waist, and fat. The results continued to be observed at week 52. That is a year of promising results for this meal plan. The results are only for the 5 and 1 plan only. What about the others? Now, let's take a look on the right, article published on the Nutrition Journal. The optimal weight 4 and 2 in 1 plan was found to be effective for weight loss and significant improvement in blood pressure and waist. This result was found in men, women, and people who are aged 65 below or above. The adherence rate to the plan was also quite high, more than 85%. This means 85% people continued with the meal plans that they began with in the beginning, which the dropout rate is relatively low. For those who are interested in reading the article, I will leave the link in the description box for you. Generally speaking, Medifast is offering meal replacement to control the client's consumption on the calorie intake, restricted between 800 to 1000 calories on a daily basis. Because of that, Medifast is ideal for people who haven't gotten results from a traditional healthy meal plan. They feature meal replacement items and provide support from coaches who were once the clients before, who should be well aware of the difficulties and challenges that dieters are going through. Actually, there is a YouTube video of the Medifast CEO speaking on CNBC discuss the company. But we think that video was a bit outdated in 2020. In case any would want to watch the video, the link is also in the description. Now we are done with the background. Let's get into their fundamentals now, examining their numbers in the past years and forecasted growth rate. Looking at their reported numbers in the past 5 years, we can see that the revenue was growing at a compound annual rate of 50% and the earnings per share was growing at a compounded annual rate of 57%. These numbers are outstanding and are massively killing all the metrics we could ever found in the market. The numbers could perfectly compete with any of the big name tech stocks in the market. Their EBIT margin has been keeping at a stable rate, from 13.1% in 2017 to 14.2% in 2021. While their net income margin is also keeping around 9.2% in 2017 to 10.7% in 2021. Even though the margin is not expanding like crazy, their year-to-year change in both EBIT and net income is absolutely astonishing. These numbers prove that the company is growing fundamentally and solidly to bring in more clients using their products. Is this what we got from their fundamentals? Absolutely not, otherwise, it wouldn't be one of our highest conviction plays in the portfolio. Let's get into other numbers that could literally blow our mind. Here are the ratios on return on assets, return on capital, and return on equity for the past 5 years. Their return on assets grew from 18.5% in 2017 to 40.1% in 2021. Their return on capital grew from 36.4% in 2017 to a mind-blowing number, 92% in 2021. Also, their return on equity grew from 27.1% in 2017 to another mind-blowing number, 91.2% in 2021. Listen. Can anyone find such a company with this kind of metrics and ratios? If anyone does, leave the company name in the comment. We are more than happy to find out and get to know more about it. Back to Medifast, these numbers are just simply killing it. $100 in the company's equity that generate 91% net income on a yearly basis. We cannot hide our first impression seeing this. Just jaw-dropping. Okay, let's get back to the fundamentals. Perhaps some might think that they generate the income by raising a lot of debts. Unfortunately, it is another no. Their total debt to equity is only sitting at 16.1% in 2021. The total debt to EBITDA is 0.14, which means the company can simply paying off all their debts in just a matter of seconds. Then some might ask that they must be diluting their outstanding shares to their shareholders. Another no. In fact, they are buying back shares on a regularly basis. Now let's look at their historical valuation for the past 5 years. All the numbers are in their next 12 months. We have the enterprise value to revenue, enterprise value to EBITDA, price to sales ratio, and price to earnings ratio. The average EV to revenue is 2.09, while the EV to EBITDA is 13.41. Compared to the multiples we have now, the EV to revenue is 1.18 and the EV to EBITDA is 8.05. In order for Medifast climbing back to the 5-year average, we can find that there will be a 77% and 66% upside. What about their PS and PE ratios? The average PS ratio is 2.26 and average PE ratio is 21.73. In order for the current multiple of 1.22 PS ratio and 12.05 PE ratio back to the average range, that implies an 85% and 80% upside potential. One most important thing that we shouldn't neglect is that, other than the percentages that we should mention, such as 77%, 66%, 85%, or 80% upside potential, these numbers are just assuming and forecasting the company's growth for the next 12 months. Can we expect a continued growth from the company for next couple more years? The answer is yes. They are forecasted to grow their revenue at 14% and their earnings per share at 16% compound annual growth rate to 2023. These are the numbers that we have in hand right now. It wouldn't be a surprise to us if the company beats their guidance and outperform the numbers. As of right now, the company's current PE ratio is 13.4. If we calculate their PEG ratio, which is the PE to growth ratio that adds in expected earnings growth into the calculation, dividing 13.4 by their expected earnings per share annual growth rate of 15.8%, we will have a PEG ratio of 0.84. This indicates the growth rate is outnumbering their current PE. Normally, or a general rule of thumb, a PEG ratio of 1 is considered fairly valued. The ratio lower than 1 indicates the stock might be undervalued. Perhaps some might check with the mega tech stocks. We are very unlikely to find one to have the PEG ratio under 1. That further proves the attractiveness of this stock. Other than that, the company is paying dividend to the shareholders, which is about 3.2%. That adds another tick to the checklist. Slightly switching our attention here. Are there really no flaws in the company? We need to know the potential downside risks to us. Reading the people's comments on the company products, we found that people have said their meal plans can actually induce rapid weight loss, but those losses could be difficult to maintain. Some might also say that the meal plans help lose weight due to severe calorie restriction, and the approach is tough to stick with. Even though This is quite the contrary to the findings of the academic journals that show the continued maintenance of weight loss by 52-week and at least 85% of adherence. We as investors should acknowledge and recognize the comments that people are making. We have to read the stories from both sides to get a better picture. At least we now know that some might have found the possible drawbacks of this diet program. One more thing that we would like to raise on the associated risks. The CEO of Medifast, Dan, does not have an amazing track record in this management working for other big-name companies. But since his appointment as CEO in 2016, we can surely agree that he has brought the company to a higher level with his experience and expertise. Also, the ownership that he has at the company is merely 0.14% of the outstanding shares in the company. He was not the founder of the company, in case some might think that this could be a potential risk in investing. Some might find it more reliable to have the founder leading the company. The institution ownership to the company is near 87%. Talking about our strategy, we took the advice from one of the persons who commented on our previous videos. It is important for us to show that we are actually putting money where our mouth is, showing that we are really using our money to buy the company shares. As said in the beginning, we bought the company at two different time points. The first time was back in September, and the second was last week after they released their financial report. We bought the company at $172.5 last week. We think that any price trading close to $170 or below is an excellent buy. For the price targets, we believe doubling the market price shouldn't be a huge challenge. The company is still growing, that might eventually change these numbers. If they deliver the numbers that exceed the expectations, we are very likely move our price targets upwards. To protect the downside risks, similar to the strategy that we employed for Foot Locker, we will average down for every 15% downward movement. It is paramount to not go all in at once. And one of our principal approaches of our timing to buy stocks is to identify a reasonable and fair price for the stocks that we are interested in getting a stake of, and then averaging down something close to dollar cost averaging from there onwards. We must always objectively evaluate the stock from different angles to cover all the perspectives. Having said so, we should also protect our capital by not going at all at once to cover any unpredictable events. We have shared our full thesis of why Medifast is one of the highest conviction plays in our portfolio. Thank you for watching. Press the like and subscribe button, hit the notification bell if this video is useful. You will be notified when our latest video is uploaded to the channel. Leave your comments below if there are any thoughts on our work. We hope to continue sharing our findings in the stock market. Investing is for everyone. I will see you in the next video.